Welcome to YourBit Solutions. This video is a part of the series regarding managing your finances using Excel. If you happens to be a person who have a small business where you're dealing with all these various kind of transactions on a day-to-day basis to run your business efficiently, and for the best reasons known to you, you're not using any commercial grade software to organize your financial data. That means you're either keeping the hard copies of all the receipts from these transactions handy or putting them in some sort of electronic format on your notepad or even on Excel to record them. But you're looking for a proper way to organize that data so that during any part of your business year, you have a pretty good idea on how your business is doing, profit and loss perspective wise. If that is the case, then this video series is for you. The only requirement here is that you need to be a bit friendly with Excel because that's the solution we would be using to address this problem. So what is the intended agenda that we would intend to cover here? First, we will strengthen your basics because that's very important. If you don't understand, you cannot use Excel properly to develop a solution. In this particular video, the first one, we will strengthen your basics from the accounting side. You'll learn that each transaction belongs to a small T account, and depending upon what kind of transaction is it, there are entry rules on how you'd record those transactions. And once those basics are well understood, we will then revert to a first jab at Excel solution, which would be more like an educational solution, so that the goal would be that you verify that you understand the basics. At the same time, we introduce you to the various advanced formulas that we would use to develop the solution in Excel. So that would be the goal for the first video. And then to show a glimpse of what you would be developing would be something similar to here, where you would design all of your various T accounts here, and which would be linked to your T accounts details. All the debit, credit, and total entries are automatically updated as you add more accounts. And at the same time, we will also develop a trial balance solution which will test your do the checks and balance to make sure these entries are properly marked. And if these terms looks a bit alien to you, just don't worry, we'll take you along as we go developing the solution. So once that first part of educational stuff is done, then we will start developing a more practical solution, and you will soon learn that these transactional account needs to be categorized into various families because that's how they are shown on your financial statements. In addition, you will also see that we need to address another problem because some of the T accounts will contain a lot of transactions in it, which means they are heavy volume. And if that's the case, then maybe you probably need a one Excel sheet for each account, while there may be many T accounts where there aren't many transactions in it, which means you can group them together and we use a one Excel sheet to address another category set of these T accounts. And once that is done, then we will also put together a system to address the sales tax entries in your solution. And also most of the bank accounts or the credit card company accounts, they will allow you to download the text file data of your transaction that you can copy and paste into your Excel solution, and then mark each transaction as done as you go through, and make sure your math gets updated automatically. And then finally, we will implement the income statement and the balance sheet linked with these transactions in the same file. And that way your instant profit and loss calculations would be done. And once everything is done here, you are looking for a solution, something similar to this one here, where you would see that now the design can be done in all these categories, because remember, your business will have your own unique entries, and which is fundamental reason we want to walk you through the whole process, because you would need to one way or the other extend that solution to your particular needs. So we'll define the categories, we will define the T accounts itself, and once that is done, then we will use the heavy volume accounts into one account per sheet, record all the banking transactions, and as we go, we mark these transactions, go through the various checks to ensure only the green entries are recorded into your account. So you go one entries at a time, and at the same time, we'll use the journal entries to record all these various kind of different account transaction on a one sheet, and then we will summarize all these transactions and their entries, and finally they would be linked to your financial statements, and all of this would be linked to your data there. and that would be the something similar to a final solution we want to develop. And don't be scared or afraid if you think these calculations or details look complex. We'll make sure that you are along with us as we develop the solution. In fact, in the last tutorial, we would go through a one complete exercise on how to use a full-fledged example, and we build the solution for one example business scenario. Having said all this, and the obvious question is everything here is free? Of course. And this channel is new, and all we ask for is if you like the content so far and see the planning what we intend to present throughout the series, all we ask for is kindly like and subscribe to our channel. It will help us in a better search algorithm for the Google. At the same time, we'll keep you updated as we go through these various steps. So thanks again and for considering subscribing to the channel. So starting for the rest of exercise, let's go through what these T accounts are. Any business transactions that you do in the accounting side, they should point to a given account called T account. And there are certain rules on how various kind of transactions needs to be recorded. In other words, at the very elementary level, what is a T account? As you see, there are two columns, left and right. Left is always debit and right is always credit. And that's easy, right? I'm sure you've heard the terms. Now, depending upon what kind of a transactional T account that is, either column could be considered as a positive column or a negative transaction column. And what is mean by this is that way you can have a two type of elementary level T accounts. One account is called a debit account, and other account would be called a credit account. Example of a debit account would be an asset, which would be a bank account, while a credit account would be a liability account. And and you will see that on the debit type of T account, your debit column is a positive column versus on the credit side, the credit column is the positive column for a liability account. And when we see the positive column, that column would be used if a given transaction increases the value of that account. For example, if you deposited some money into the bank, you increase the value of the bank account. That means it will go to the positive side, which would be debit in this case. On the other hand, if you use your credit card to make a purchase, that means that transaction increase the value of that particular account. And that means that entry, that expense on whatever you purchased goes on to the credit side of the liability account. And likewise, if any transaction reduces the value of that account, which means taking money out of that account or paying off a loan for a credit account, or you make a payment, then both of those scenarios are reducing the value of that particular account, which means you would be using a negative column to record those entries. So going one step further, how do you know which account would be a debit account and which kind of a transaction account would be a credit account? That brings a fundamental equation in the accounting, which means all of the assets that your business has are equal to the total number of liabilities that your business have plus your owner's equity. In fact, on the right hand side, you can consider all the liabilities. Even owner's equity is a liability because that's what the business owes to the founders of the business. So on the left hand side, where we see the asset accounts, all these accounts could be your bank account or any recoverable from various kind of a supplier that you might have, any purchase you make, your building you purchased, any stock purchase you made. All of these, your assets would be the debit type of account. All the liabilities, your bank loan or the HST that you, or the general sales tax account that you owes to the government or you owes to the third party, to your supplier, everything that comes under the liabilities account, and all those liability transactions belongs to a credit account. And same goes to the equity. All the equity accounts will be the credit account as well, except the one that's shown in red, which means any account under the equity that reduces the value of the equity, which means it go. So let's introduce the fundamental accounting equation for you, and that is the total amount of assets that your company have are equal to the total amount of liability that your company owes to the third parties and the amount of the owner's equity, which is technically a loan of the company toward the founders. So on the left hand side, all the asset accounts that could be any money in your bank, any cash account, any building you own, any automobile assets, tools, machines, furniture, anything that the company own is an asset. So all these asset accounts are the debit accounts. It also includes any money that the third parties owes to the company are also the asset accounts, and all of them are debit accounts. On the right hand side, you have the liabilities. That means any money that the company owes to the third party. It might be the loan that they took from the bank, any tax that's are due that the company owes to the government, any amount that the company owes to the supplier for the unpaid bill. All these accounts would come under liabilities and they would be the credit account. And further comes the equity. All those by the way, this list is not complete. It's just to suggest to you there may be many more entries that can be added. It's just to give you some directional sense. So in for the cases of equity, any sub account under equity that increases the equity, which means any retained earning from the last year, more the retained earning, more is the equity. Any revenue or income generated, more the income company makes, will increases the equity. Same as any paid capital, investors put more money into the company, that increases the equity. All those sub accounts that increases the equity will be the credit account. The other accounts under the family, this equity family tree, where the account negatively affect the equity, they will be the debit account. Like for example, more the expenses the company has, will the less will be the equity, so it's negatively affect the equity. Any dividend which if the founders take the money out for the dividend as to the founders, that reduces the equity. That means they are negatively affecting the equity. So all these sub accounts that are negatively affecting the equity will be the debit account. So that is a nutshell all you need to know in terms of when you add a transaction, that what kind of account you need to create, and you look at this hierarchy of the accounts, and then you assign whether the account is a debit account or the account is a credit account. So let's go one step further, which is the double entry principle. What does the double entry principle say? It says whenever a transaction is recorded, that transaction should go to at least two accounts in the opposite direction, which means if the one entry goes into the debit, there should be a balancing entry which should go to another account or one or more other accounts, and those should go into the credit side. So there are two different ways you can look at all the entries, and the things will make much more clear once we go through some example. And the converse, so yeah, here's one example. Let's say you deposit, you took a loan, and then you put the loan money into the bank account so you can run a business. So the first entry is basically you put the money into the bank and bank's amount increases, and because it increases the value, it goes to the debit. Now, because you took the loan and then the loan increases the liability, and likewise that number goes into the credit as well. Now, if you look from the other angle, the first entry went into the debit and the second entry went into the credit. So these are the two checks you can do, and the rule says when you're done with the transactions, total number of amount of the transactions into the debit side of the account, one or more accounts, must be equal to the total number of entries that you put on the right side of the other accounts. And then there's a simple example that you can also use. If you pay off the loan and then obviously the money get out of the bank, it reduces the loan. So those are the other two entries. Maybe we can try one more example here. Let's just say that you earned some income. You charged a customer for some service that you did. You charged the customer $113, where $100 was your charges of income, and the $13 is the tax that you collected on behalf of the government. That means on your bank side, you increases the value in the bank. It goes into the positive side, which is the debit. And on the right hand side, you see that your income was only $100, but now you owe the $13 that you collected on behalf of the government. So your income is increased and also your liability to the government also increases. That means all the increases should goes to the positive side on either side. And if you add up the total amount of the debit entries, which is 113 on the left, is equal to the total number of the credit entries on the right, which is $113. So your accounting is balanced. That is what they call as a double entry principle in accounting. Okay, so that brings us to the a summary of what the requirements that we need to have in the solution that we're trying to build. On the left hand side, the requirement that first and foremost would be the dynamic account, because you cannot go with a fixed list of account. Every business is different, and you should be able to add, remove the accounts into your program without much headache of maintaining all those associative formulas, and that Excel file has to be designed in such a way. Other thing is the easy to assign account designation, which means when you pick up add an account, you just need to define it, whether it's a debit or credit, or well, maybe one level further, is it an asset, liability, or an equity account, and then the system should take care of assigning the correct signs, and that reduces the chance of confusion or room for error. And then the third one was the automatic or semi-automatic double entry, because we just see in the previous slide that the entries has to be balanced, which means you should be only need to assign your first leg of the transaction into the one account, and then for the balancing side you should be only able to name the account where the balancing goes to, and Excel should automatically put that entry into the right column for the second part. So that will reduce some of the effort from the user so that you don't mix up by mistake. Then you have to have some sort of a data validation on the entries you put. You should be able to handle the sale taxes, and then the auto trial balance should also be maintained, and then building the financial statement. So that's the list of the requirement we need to accomplish. To do that, some advanced formulas in the Excel would have to be used, and we'll walk through, but it's very important that you make yourself familiar with these formulas, which are a part of Excel 360, which is the requirement for this presentation or program that we're trying to build. And for that purpose, there's a link on the top of your video that you can click and watch the a special video that I made just to familiarize yourself from purely Excel perspective that can put you some comfortable. But if you already know these formulas, then you're good to be okay. And I also put these link into the description below. So that brings to the end of this particular video, and once again I kindly ask that if possible please like and subscribe to this video, so when we post to the next segment to the video, you can go and watch complete the whole series, you will be properly informed. Thanks again for watching the video, and look forward to see you.